when we first said it, people thought we're insane, but I think it's becoming pretty obvious that AI and robots are replacement humans. And we're going to have infinite at some point. So the idea is, where does we have infinite? Because that breaks the whole GDP magic formula, right? Nothing makes sense anymore. We call that point the economic singularity. And we kind of finger in the air said, probably by about 2030, because everything is going exponential in terms of speed of AI and robots, we probably have no idea what an economy looks like anymore, or what it means. Everything we all look at is going to fall apart.
What's unfolding right now could redefine the global financial system. In just the first half of 2025, Bitcoin has climbed nearly 50%, outpacing both gold and the S&P 500. Ethereum isn't far behind, driven by institutional demand and persistent liquidity support, according to Real Vision's CEO Raoul. This momentum isn't random, it's the direct result of rising global liquidity. In fact, he argues that liquidity is now more influential than earnings, valuations, or even rate policy. Before we go further, if you're getting value from this video, make sure to hit the like button, drop a comment with your thoughts, and subscribe. It really helps the algorithm push this to more people who care about Bitcoin, macro trends like you. With central banks around the world coordinating stimulus and suppressing real yields to offset aging populations and lagging productivity, capital is being forced into higher volatility assets like crypto. And as technologies like AI and blockchain compound exponentially, Powell believes crypto won't just grow, it could form the foundation of a new global financial architecture. Stick around until the end of the video, where Raoul and Real Vision's head of macro research Julian Biddle break down how this entire transformation could unfold and what it means for crypto in the years ahead.
From our work, we kind of noticed the business cycle structure. We're both business cycle analysts. We've both been looking at them for a long time. It changed after 2008, and it became like a metronome every 4 years. That's only happened once in the past, which was the 1950s and 60s, where it became very, very cyclical. But this is perfectly cyclical. And it got me thinking for a while, what the hell? So many of us didn't understand what happened to asset prices after 2008. We kind of knew quantitative easing was happening. We kind of knew stuff, but we didn't figure it out. And what I suddenly realized is that in 2008, we had a debt jubilee. And in fact, it was just forgiveness on interest. You don't pay interest payments. Remember, we did that over COVID. Exactly same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now, where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. Yeah, it is the best chart in the world because it then tells you, okay, if I'm to allocate to the S&P 500, I'm basically breaking even versus debasement. So the S&P 500 is not really adding much value. Well, when you look at the Euro stocks and other markets, which are priced in their local currencies, you put them in dollars, they look similar. All the markets look very similar once you adjust for debasement. So that was interesting to me. Gold, complete almost flat line, really, versus debasement, as it should be, right? That's gold's job, to be the stable currency. And once we looked at the world through this lens of the debasement of fiat currency, which again is still contentious, becoming less so nowadays, but it was really contentious when we started it, we realized there's actually only two assets that outperform this. One is tech stocks and the other is crypto. And so that completely changed how I allocated and how I understood tech stocks. I was a macro guy. I hated tech stocks. They're always too expensive. You're always a value guy. And I realized none of that made sense in this market. That's why the value investors have been getting killed, is what had happened was all of this. Now, what is driving this? And I think, Julian, if you can just bring up those demographic charts, because these are the absolute most important charts in the world, really, to understand. GDP growth is driven by this magic formula, which is debt growth plus population growth plus productivity growth. That's how you drive trend rate of GDP. Now, debt growth's gone to extremists, and now really we're just servicing debts. Basically, GDP keeps falling, and it's falling over time, the trend rate of GDP, because of the magic formula. And Julian, if you can get to the demographics charts, because they're the key ones here. The issue is here, the biggest secular factor in all of markets is this one thing, is the aging of population. And we can see the births rate is falling in the US much faster elsewhere. So that obviously is a function, the labor force participation rate, the size of the workforce, is a function of births, deaths, or the number of people being born, whatever, right? And you hear the phrase demographics are destiny. They are, until the AI and the robots come, which are basically artificial humans. This is the problem that faces us all. But there's a way that they've got around this. If you go to the next chart, is they've increased government debt to offset the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands, and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. And this is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector, because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. Even if you look at real estate adjusted by the debasement by liquidity, it's basically a flat line. But wages are a variable input. And so what you find is that wages do not account for this. It's also the same factor that is driving PE ratios that drives everybody nuts. Why are PE ratios going up over time? Because the P goes up because of debasement. The E is a variable and doesn't. So it always goes up in line with debasement. And we've shown that over time too. So this is the really big picture of what we look at. It allowed us to understand there's only two assets to own. And then we got to a further realization, which is, okay, if 97% of all of NASDAQ's price action is driven by debasement. It's the strongest factor we've ever had in any macro regime in history. Okay, great. That makes macro super easy. For crypto, it's 90%. So we've basically got a factor that's so powerful that nothing else matters. Brilliant. So then let's take the NASDAQ. If we've got one force, one economic force, we take the NASDAQ, we divide it by by Bitcoin, it's down 99.97%. So you kind of get one asset allocation only, which is crypto, which is bizarre. In the macro world, we now think you need concentrated portfolios as opposed to diverse portfolios. In fact, diversification just destroys returns now because you've got one clear macro factor.
Since 2008, central banks have injected trillions into the global economy through debt and stimulus, expanding global liquidity by nearly 8% per year. That constant flow has quietly eroded the value of fiat currencies, making it harder for traditional assets like stocks, real estate, and even gold to truly outperform. Bitcoin, on the other hand, continues to break away from the pack. Built outside the fiat system and engineered to be scarce, it resists the very debasement dragging other assets down. Meanwhile, aging populations and declining birth rates are forcing governments to lean on increasingly unproductive debt once again financed through more liquidity. In a world like this, Raoul believes that focusing on crypto assets isn't just a hedge, it's now the smarter, forward-looking move.
We saw this happen in the 1950s and 60s. I alluded to that before. World War II, the US economy was over 100% of debt GDP. Most economies were. What did they do? Financial repression. They shortened the debt. They rolled it every 4 or 5 years. They use yield curve control to financially repress, which is essentially currency debasement, because they, at the time the dollar was pegged to gold. So it's the only way of doing it that way. And then what they did was wait for population growth. They're the baby boom, the largest in history, and productivity growth from technology. And what happened was GDP grew faster than debt. And over time, debt to GDP fell to a manageable level. Until the inflation of the 70s, driven by demographics, kicked in as everybody started getting into their 20s. And so we've seen that before. So this way around, our thought process, when we first said it, people thought we're insane, but I think it's becoming pretty obvious that AI and robots are replacement humans. And we're going to have infinite at some point. So the idea is, where does we have infinite? Because that breaks the whole GDP magic formula. Right, nothing makes sense anymore. We call that point the economic singularity, and we kind of finger in the air said probably by about 2030, because everything is going exponential in terms of speed of AI and robots. We probably have no idea what an economy looks like anymore or what it means. Everything we all look at is going to fall apart. So we kind of think we've got 5 years, so this cycle and the next cycle. And part of something Julie and I talk about between us too is like this cycle, people are starting to get it. I think once we get through a pause that refreshes, a contraction in liquidity, the cycle, I think the next cycle, everybody's going to go all in and realize it's the kind of end of times, because we just don't know what's beyond that. Nobody does. And anybody who says they do is lying, because we have literally no idea. When you've got free intelligence, infinite intelligence, and we don't know. And we don't know, what the energy constraints are going to be, or whether there are any, or whether we solve them. We just don't know. So I'd rather be honest with ourselves and say, right, okay, we got 5 years. That's it.
Yeah, I mean, the everything program will basically work until it doesn't. And the reason we know it'll work is, if we come back to the charts for a second, as Raoul had said, GDP's in decline. It's trend rate of growth is 2%, and keep that 2% in mind, because that's important. The working age population is in decline, productivity is in decline, but debts have exploded. And, something a lot of people talk about is the fact that the private sector has deleveraged since 2008. But what people don't understand is that this has been a forced deleveraging by the banks by tightening credit to households, right? But because productivity is in decline and demographics are in decline, this debt can't just disappear, right? We can't grow ourselves out of that debt. And so we went from 140 to 120% of GDP. Well, where did it go? Well, the public sector took it on, right? So it went from 100 to 120% of GDP. And this is where the problems start. And this is where we uncover the everything code. We've been unlocking it, over the years. But essentially, if trend rate of GDP is at 2%, let's say interest rates are at 2% for easy math. We know they're not. We know they're at 4%. But that all of a sudden means that 100% of GDP is going towards funding private sector debts, right, which is an unproductive source of GDP. So to avoid a GDP doom loop, the only thing that you can do is, again, put it on the balance sheet, right? And it's just a huge, and if you just look, this is US total liquidity, which, as Raoul said, it's public plus private liquidity. There's just a vast amount of interest payments which still need to be monetized. So what's going on is, which is I mean, they're basically issuing debts. They're basically issuing debts to finance the interest on the existing debts, which at the end of the debt refi cycle, once interest rates going to scan down a little bit, once interest rates come lower, it just gets thrown on the balance sheet, right? But there's two phases to the everything code. China's past phase one because bond yields have come down because their economy has, nuked, to an extent. But in order for them to actually make use of the balance sheet, rates have to come lower first. So that's phase one. And then phase two is debasing.
And Felix, the other important thing, and I'm sure you've been talking about this as well, is they keep shifting the game. The game was the balance sheet. We all knew the game. Then it moved from the balance sheet to the Fed net liquidity. So then everyone's working out the TGA versus the reverse repo. Yeah. And then they went, actually, it's total liquidity because we're going to stuff it into the banks. And now the next one is they're going to stuff it into stable coins. All they're doing is fine. I mean, that's Scott Bessement's job, and Janet Yellen's job was the same. They're bond salesmen. They're just, they're masters of the universe bond salesmen, and their job is to find where to absorb this, and that is all part of the M2 growth.
We are no longer in a normal economic cycle. Low productivity, aging populations, and unsustainable debt have pushed policymakers into one consistent response: more liquidity. Central banks keep expanding the money supply and suppressing yields, quietly eroding fiat currency value. The impact may not always be visible in inflation stats, but it's unmistakable in asset price distortion. Traditional investments like stocks and real estate aren't generating real growth anymore. They're just treading water against dilution. Bitcoin and crypto, on the other hand, have consistently outperformed when measured against liquidity flows. And if these trends hold, crypto isn't just here to stay, it's on track to become the dominant asset class of the decade. Thanks for watching. If you got value from this video, consider liking, commenting, and subscribing to help the algorithm push this to more smart investors like you. I'll see you in the next one. All the best.